IRR, or the internal rate of return, this is the annualized average rate of return that a series of cash flows gets. So that's like a really technical thing to say. So imagine that you're investing in the diversified fund, and there's 10 investments in the fund, and one of those investments we're going to build a brand new apartment building. What are the cash flows associated with that? Well, we're going to take $10,000, $1 million from all of you, invest it in the down payment to buy the land and to pay for the construction, and maybe 2.5 years later, the second cash flow will be a refinance where we can return, let's say, $50,000 of the 100 comes back to you during the refinance. And then a couple months later, we've got a cash flow asset, and now we're sending back a small cash flow, maybe $1,500 a quarter for a number of quarters. And then finally, we're able to sell the property, and we return the rest of the $50,000 that you invested. So you invested 100, 50 came back at the refi, 50 comes back at the end, and then we would give you the profit as well. And let's say your share of the profit is $90,000, and that's at the end of year 5. Those would be the cash flows associated with that investment, and the internal rate of return for that would probably be about 17%. The way to think about that is that if you took $100,000 to a bank and you had a savings account that paid 17%, you would be able to basically recreate the cash flows that we gave you with that apartment investment. So it's just a way of measuring the rate of return over time.